What if the country meant to save Europe ends up triggering its next crisis? Germany's 1 trillion reboot was supposed to mark the start of a new era: military strength, industrial revival, and green infrastructure. A high-stakes plan to reverse decades of underinvestment and reclaim Germany's role as the engine of Europe. But just months into Chancellor Friedrich Merz's term, that vision is already cracking. Politically, economically, and now financially. His ruling coalition has imploded over a procedural court vote. Gas reserves are worryingly low despite summer relief. And in the bond market, investors are quietly backing away, demanding the highest premiums Germany's paid since the Eurozone crisis. Bloomberg calls it a technical sell-off, but markets are signaling something far deeper: a loss of confidence, the kind you can't reverse with talking points. This week, Germany's 30-year bond yield surged to 3.23%, the highest since 2011. Not because Germany is weak, but because it's asking for too much, too fast, with too little consensus. The finance agency now says it will issue 20% more debt than previously planned. And investors aren't just pricing that in. They're pricing in doubt. And this comes as Merz's own coalition is already fracturing. Just days ago, his conservative lawmakers blocked the appointment of a Supreme Court nominee, not from the opposition, but from his own coalition partner, the SPD. The SPD, Germany's center-left Social Democratic Party, shares power with Merz's CDU-CSU, the country's center-right bloc. Together, they formed an uneasy alliance to push through Germany's post-pandemic economic reboot. But that partnership is fraying fast. The official excuse for blocking the SPD's nominee? Alleged plagiarism. But behind the scenes, it was ideological warfare. Some CDU members said the nominee was too left-leaning on abortion and civil rights. The SPD called it a smear campaign. The vote collapsed. Parliament adjourned in chaos. And trust, the foundation of any governing coalition, just vanished. CNBC might frame this as a coalition hiccup, but in the context of a trillion-euro spending agenda, it's more like a cracked foundation. Because if Merz can't pass budgets, the entire plan stalls before it even starts. Meanwhile, energy security, the issue that nearly broke Europe in 2022, is becoming fragile again. Germany exited winter with gas reserves at a 3-year low. Traders were uneasy. There were whispers of state intervention. The whole continent watched. Then came a ceasefire between Israel and Iran. Gas prices crashed. Summer-to-winter price spreads widened. Storage became profitable again. Germany's bookings surged past 70%. In 1 week, traders pumped in 10 terawatt-hours, the biggest weekly build since the energy crisis. Problem solved? Not quite. Germany still trails France and Italy. Its biggest storage site in Radon remains mostly empty. And the country's own storage operators warn 70% won't be enough in a cold snap. And here's what no politician in Berlin wants to admit. If cold weather hits early and stockpiles are still underfilled, the crisis could come roaring back. Prices could spike. Industrial rationing could return. Public confidence could crack. Just as political trust is collapsing. Just as bond issuance ramps up. And Germany's not borrowing in a vacuum. The US is running one of the largest deficits in history. Long-dated treasury yields are nearing 5%. Japan and the UK are under pressure too. Everyone's trying to tap the same pool of global capital. And global capital is getting choosy. Sovereign wealth funds, pensions, insurers. These investors are watching bond auctions closely and charging more when they smell risk. Germany's term premium has doubled this year to its highest since 2023. That's the market's way of saying, we'll lend, but not cheaply. In normal times, German debt is Europe's gold standard. Today, it's still trusted, but it's no longer immune. If global investors start questioning Germany's political coherence, energy readiness, or fiscal discipline, that $1 trillion dream won't die in a headline. It'll fade slowly through rising yields, failed votes, and lost credibility. Because this isn't one crisis. It's 3 crises converging: coalition dysfunction, winter energy risk, and bond market revolt. And when a country becomes politically paralyzed, energy dependent, and financially stretched all at once, markets don't wait around. They reprice risk quickly. Germany thought it could borrow big to rebuild its future, but in a world where the US is flooding the market with debt and bond vigilantes are back, there may not be enough patient capital left to fund everyone's dreams. This isn't just a German story. It's a warning for every country trying to run 21st century ambitions on 20th century assumptions: cheap debt, stable coalitions, endless investor appetite. That world is gone. And if the bond market stops believing, the plan doesn't just get more expensive, it stops working. If you missed our original breakdown on Germany's $1 trillion bet and how it was designed to flip the global economy, you can watch it here. And if you want more macro stories like this, the ones that mainstream outlets skip but markets never ignore, subscribe to Global Notes by JP. No bias, no noise, just the signals that matter.